Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a lifelong real estate investor, advisor, and coach, as well as the founder and team leader of Streamlined Properties. Whether you're looking to start from scratch, get to the next level, or just for a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome to episode 200 of Zen and the Art of Real Estate Investing. If you listen to the end of 199, you know who the guest is today. And I pre-planned this by asking him when I was at BiggerPockets conference in Cancun in October, and he said yes. So for the second time on this podcast, my guest for episode 200 is the host of the BiggerPockets podcast and On The Market, Dave Meyer. And we go pretty deep on how the U.S. election could affect real estate investing in 2025, because we recorded this the day after the election. So about half is on what we think could happen, and that's a lot when I say we, Dave. And then the back half is on a lot more. So stay tuned, and thank you so much for being part of this journey that got us to episode 200. Let's go with Dave. This is episode 200 of Zen and the Art of Real Estate Investing with my guest, back for a second time, Dave Meyer. Dave, if you don't know, is the head of real estate investing at BiggerPockets. He's the host of the BiggerPockets podcast, as well as On The Market podcast. Dave, welcome to the show.
Thanks for having me back. I'm excited to be here for this milestone episode.
Yeah, I really appreciate it. And I definitely earmarked you when we were at BPCon for episode 200. Your last appearance was episode 33 in March of 2023. A lot has changed since then in the real estate world, right?
Yeah. And you've been productive. You've made a lot of shows in just the last 18 months.
Yeah, I have been burning it up. But we are recording on November 7th, one day after the United States election. So let's just start with that. Do you think that this is going to maybe undo a little bit of a logjam in the real estate world?
I think that emotionally, it will unlock a little bit of the housing market. There's been some data and surveys out there that show that up to 25% of prospective homebuyers were waiting until after the election for a variety of different reasons. And just the fact that it's over, I think, will allow people to start making large financial decisions again, not just in the housing market, but other decisions as well. Even if it doesn't really change anything with the fundamentals of the market right now.
Yeah, I feel like everyone was waiting, no matter which side they were on, just for it to be over, because I don't think anyone personally knew, like, well, hey, what's going to be the result the day after it's over, which is today when we're recording. But is there anything that you look to that's going to be really important to see, in the next few months as to what transpires that will, help us assess the housing market maybe in a little bit of a different way?
I think there's a lot that we have to wait and see right now. I'm very eager to see which policies that Trump has proposed he'll actually follow through with and what shape that they eventually take, because he's suggested some big ideas like tariffs, for example.
Right.
He's at some point said that he's going to put a 20% tariff on everything and 100% tariffs from China. A lot of people think those are just negotiating tactics and those won't actually go through. And I believe that, the size and reality of whatever policies do actually get passed are going to be really impactful on the housing market, like huge across the board. Tariffs are largely believed to be very inflationary. Smaller ones might be absorbed just fine into the market. So that's just an example. But we also look at things like his proposal to deport illegal immigrants, which could have an impact on the housing market. We can talk more about that. Yeah. He said he's wanted to be more involved with the Fed, which could be really impactful for the housing market and the broader economy. So, right now we're sort of, there's a lot. It really is. And I don't always think that presidents have that big of a impact on the macro economy and the global economy. But I think it's a little different right now if he goes through with a lot of the things he's been saying. So it's something we all definitely need to keep a really close eye on.
Yeah, I feel like now more than ever is a very, very important time for real estate investors to be agile and keep their, head on it. I particularly don't watch the news, but, keeping tuned into things like On The Market are ways that people can stay kind of ahead of the curve and just know, well, you guys are always, it's like, wow, I'm like, wait, that just happened. And now here comes an episode. So I think it's really important. But don't you think agility is really important?
No wonder you're so zen, man. Like not watching the news is why you could be zen about real estate investing and the economy.
6
Maybe
or 7
I need to
years.
do that more.
Yeah, but I feel like, this kind of agility now is so important because a lot of different things can happen and you have to be able to pivot. So what do you tell investors now who are looking at investments, but they're definitely going to have analysis paralysis issues because of all the things that you just talked about? Like, how are they going to be able to make decisions, not knowing what impacts could come?
Yeah, I think there's two camps. Some people think that you should wait until, let's say, February, March, because typically this is true of all presidents. Like the majority of the stuff they do is usually in the first 100 days, like a lot of executive actions, especially because Trump has the Senate. And although we don't know right now, it's looking like probably the House as well.
Yeah.
And so there's probably some stuff that he's going to try and implement right away. And those are usually the big pillars of his agenda. And so we will probably know a lot more in the first couple of months. But I always caution people about waiting for those types of things because we don't really know. I was reading this morning, just as an example, back in the 2016 campaign, Trump campaigned on tariffs and, starting, trying to equalize trade relations with China. And he did that, but it wasn't until 2018. It took him 2 years, for example, to figure out the right way to do it. Yeah. And that might happen again. So are you going to wait 2 years to make a real estate investment? I wouldn't recommend that, especially because a lot of people believe that Trump's policies are going to be stimulative and even to the point of perhaps inflationary, which means you probably would want to invest sooner.
Right.
For me personally, I think that there's actually going to be some opportunity in the next few months just because sellers are still going to have to sell. And I do imagine that the average home buyer is probably going to still be a little bit gun shy. Yeah. And so as an investor, you might be able to swoop in, and I'm not expecting huge discounts or fire sales, but maybe able to find some equity and deals under value in the next 2 or 3 months before the spring selling season.
Yeah, I think it's wise too to always keep, your nose to the grindstone and always be looking, because I think this is a perfect time where people can use it as an analysis paralysis tool to say, well, I can't decide because I don't know what's going to happen. But as you said, that's going to be going for a couple of years. There's going to be a lot of different things that could come. And I agree. I think there's always opportunities, and I think if you look at what we might expect to happen, it's more likely that you're going to have appreciative opportunities if you get in now based on expectations.
Yeah, that's my general feeling. I'm still trying to wrap my head around everything, but my general feeling is that we probably will see the housing market get some tailwinds again in the next year or so. I don't know how soon, but I feel like just generally that's kind of how I'm feeling. And we could talk about rents too, but for other reasons other than the presidential election, I feel like we might have some resumption of rent growth in the next few years. So those are both good things for investors. I will say though, my expectation is that between now, it's November 7th, and the inauguration, and maybe even for a few months after that, I do expect interest rates to stay relatively high. Even though today, we're recording this, the Fed's expected to cut rates in a couple of hours, and they probably are going to. I don't think that's going to provide a ton of mortgage relief. And so if you're waiting for affordability, you're going to have to keep waiting. But this is another reason why I think, there might be deals to be had because sellers are going to keep selling. And if other people are waiting for affordability, you might, if you can make something pencil with today's rates, it might be advantageous. And then, you never know if you'll be able to refinance. But if it works today, there's a decent chance that you're going to have an opportunity to refinance and improve your cash flow in the next few years.
Right. But that's just another part of educated risk as a real estate investor. You're never going to have a crystal ball. We don't know what's going to happen, but you can kind of hedge your bets that way. But hasn't it been such a long plank to be standing on for home buyers now who've been keep waiting? we all know that rates aren't going back to 2 or 3, but I feel like now people are like, well, maybe 4. And it's like, but it's not 4. Is it 5? There's a lot of people that I think are still stuck in homes that are probably too small for them because it doesn't make sense to move out of their 2.75 rate. How much of an effect has that had on the housing shortage, just in terms of inventory that's out there?
It's a ton. I mean, we see that there's a big lockup in home sellers because they're locked in at these super low rates. And there's been a bunch of research from Zillow, and there's another really good company called John Burns Research and Consulting. They do a lot of this type of research, and both of them independently had similar findings, which helps, lend some credibility to it, that the sort of quote unquote magic number to sort of unlock inventory is somewhere between 5 and 5.5%.
Yeah.
And although people say, oh, now it's going to get down to 4. I actually think the opposite. I think we're going to see rates stay higher because just gameplay this out a little bit. The rates only go down when the economy is not doing well. And so Trump has proposed a lot of stimulative policies like tax cuts. And so that will be good for the economy, but the Fed will have no reason to lower rates. And in fact, they'll probably want to keep them high to prevent a roaring economy from turning into inflation, which can happen. And so to me, that seems like the more likely scenario. And although Trump has said that he wants to have more influence on the Fed, I think that's one of the bigger question marks about his policies. Like, it's unclear what that even means. And even if that happens, and even if they push rates down, mortgage rates are tied to bond yields, and bond investors aren't controlled by the president. They're going to make their own decisions based off inflation risk and, other asset classes, what's happening in central banks across the globe. Like, it's a really complicated thing. And so I don't really feel like we're going to see mortgage rates start coming down just because Trump was elected. In fact, if I had to guess, I think his election means that we'll probably have rates stay relatively higher. I think they'll come down from where they are now, but I don't think they're going to, if they were going to bottom out at 5.5% before the election, I don't think that's really changed all that much.
Yeah. Well, I want to get your take on this. I've been using the term asset hunter. I know we've talked about this before. And I think now, again, it's more important of a time than ever to just continue to be an asset hunter, because it's like you said, I mean, for all different things, commercial deals pencil in a different way because you're obviously using a ton more data. But residential, you still have to be on the lookout for what you're seeing. And that means getting more reps, looking at more properties, seeing what's out there, and then deciding okay, with all of these variables that are out there where things could go up, could go down, rates could go up, could go down, you have to start really focusing on the asset. And I think that a lot of investors are missing that because it's so easy to get data now. When I was younger, there was no internet. So I couldn't, run through 15 properties. I had to go look at them all. And I think if people get inside houses more, they're going to get a better perspective on what actually is an asset, like neighborhoods and everything. What do you think about that?
I completely agree. That's the only thing we really have control over, right? Is trying to find assets that have intrinsic value and that are going to thrive and preserve value regardless of interest rate environment, regardless of political swings. And to your point, I think that just getting in and looking at them is a really good way to do that. And this is why I think there might be some discounts. And again, not huge discounts, but these types of environments where there's a lot of uncertainty and it's pretty expensive, it means that there aren't going to be a lot of buyers, and there's benefits to not having a lot of competition. There's also downsides to trying to buy with high interest rates, but I encourage people to try and look at the trade-offs of every market, because even when prices were low, it was super hard to get debt. There's always trade-offs in what the market is giving you. And right now it might be low competition. And if you're an investor, that's, I recommend trying to take advantage of what the market's giving you.
Yeah. I wanted to hit some geography with you because I know it's one thing that you study all the time. You're putting out a lot of data about, where good places are to invest. Not necessarily in terms of the election, but what we've been seeing a lot in a lot of data is, Texas and Florida is down. But doesn't that mean that that's an opportunity for investors over the long term, even though it was very, very high?
It depends. Yeah, I think the fact that Florida and Texas are seeing corrections, it doesn't really concern me all that much. If you look at
Same.
these markets, state-wise, they've grown as faster than any other state over the last 5 years. And a 1%, in Florida, I think the average, the total state is down like 0.5%. So
Yeah.
it's basically flat. It's technically down, but by any analyst would say that is flat. And so could it keep going down? Probably. If rates stay high, it could keep going down a little bit more. But I don't really worry that much about these short-term variances in prices. I think it really comes down to, the asset, like you said, and supply and demand. So I will say that the fact that it's down doesn't bother me, but I do have some concerns about the fundamentals in some parts of those states, like saying the whole state, in some parts of those states do concern me because there's been so much building. You see that, these have been popular states for a long time, and builders see that and developers see that. And so a lot of these markets, like Austin is, sort of the poster child of this, is like there's just been so much construction that even with the amazing demand growth and population growth, that supply is outpacing it. And that is likely going to take some years still to correct itself. But if you're looking on a 10-year time horizon, I think it's good. The other thing that concerns me personally, and people have different opinions about this, but I worry about insurance and extreme weather in Florida a lot.
Absolutely.
I've had opportunities to invest in Florida, and I just get too anxious thinking about these hurricanes and business interruption. And it's not for me. But I think people love Florida. People are going to keep living in Florida.
Yeah.
And there's going to be opportunities there. It's just me personally, as an out-of-state investor, it's not. I think there are ways to get similar benefits in a state that doesn't have the insurance and weather risk that I see.
Yeah, I'm the same. I lived in Florida for 14 years. My friends were sending me pictures, but it was interesting because I decided to go back into short-term rentals. So I started to buy this cabin, this A-frame, close to Asheville, because Asheville was I was like, oh, it's completely weather resistant. This is a great opportunity. And before I closed, of course, the everything happened, and Asheville, suffered. And I was in Black Mountain, and it wasn't as bad. My property wasn't really fully damaged, but I decided I can't do it. The infrastructure and the whole reason of me going there was now depleted. But that was an area that I had categorized over years of looking as weather resistant. So how do we start to identify what is really weather resistant anymore?
I honestly, it's weird. It's crazy. I have started looking into this a lot, partially just because I love looking at maps and data. It's just weird. But
everybody who knows you knows that's you just dream about data and maps going together.
Just a weird guy. But yeah, it's obviously not my expertise. I know nothing about climate and weather data, but I do look at what experts put out. And the general consensus is that the Midwest and the Great Lakes region, as well as New England, are sort of the more quote unquote climate resilient places, as is the Pacific Northwest, so Oregon and Washington State, and I think parts of Idaho as well. Yeah. And the thing that I always find hard about this, and I want to learn more about, is a lot of times these maps are aggregations of all these different climate factors that I don't know if they're as important for real estate as an investor. For example, I was reading about this debate about Phoenix, for example. It's rated as low climate resilience because it gets super hot there. Is that going to increase your insurance because it's super hot? I don't know. I don't know. For me, it's harder to draw that conclusion. Whereas hurricanes, yes, your insurance is going to go up. I know this personally from some places I own in Colorado, wildfire risk, that is going to drive up your insurance. So I think there's some nuance to it that I don't fully understand, but I think is worth digging into because, this is, people have turned this into a political issue. I think a lot of it is an economic issue. If you look at just the cost of these things, it's being borne out. I have a lot of friends who invest in Florida who are selling or leaving because the insurance costs are just too high. And so as an investor, I do think you need to pay attention to this stuff.
Yeah, and I would expect, insurance costs to, quote, level out at some point. They're still going to remain much higher for a while, but, it's just part of doing business. And like we both said, like, hey, Florida's maybe not for us. But if a lot of people are thinking that and we're thinking that, it does mean that there's opportunity there for people who are already in the market and understand the insurance dynamics and can pencil that in. Also ends up meaning sellers probably going to have a little bit hard time to sell, to providing more opportunities for those who, want to take that little extra risk that may be there over the long term, depending on where you are in Florida.
Yeah, absolutely. And I think there will be some sort of solution. There's already a sort of a public-private option for insurance in Florida.
Yeah.
My best guess is that will get expanded some way, somehow. I have no idea how, but, I think the idea that there's just going to be no insurance is a little unproven, at least at this point. And something, some company will figure out a way to make money off of it and offer something to investors and homeowners.
Especially in Florida. They always figure something else. But in terms of the Midwest, I mean, for your own personal investing, you started thinking more turnkey in the Midwest. Am I right about that? Or at least in areas like that?
Yeah, just in the last year or so. And I think about expanding into other markets in the Midwest. I like it for a lot of personal reasons. It has more cash flow. We've seen appreciation in the Midwest be really strong, which wasn't always historically true. And there's no saying that that's definitely going to continue. But I just believe in affordability as like a major driver of appreciation over the long run.
Yeah.
And that markets that are not affordable are going to attract people. They're going to they're going to attract businesses because they're going to create tax incentives and the land is cheap. It's going to attract businesses that will bring jobs, that will bring people who want to move there. And so I'm not saying like people are all going to leave the Southeast, but I do think my just personal hypothesis is that a lot of the big major cities in the Midwest are going to grow. And so I like the idea and I'm willing to bet on that, especially because it's so affordable and you can find cash flow. So it seems like a low risk bet to me because I'm like, hey, I can buy an on market duplex that cash flows. I'm willing to put some money there and see if my thesis is right. And that's not the only thing I do. I sort of try and spread my portfolio around, but I do think for me at least, it's one bet that's worth trying.
Yeah, I agree. I've been kind of digging in more as well. I've been getting more into syndications. I know you've invested in syndications as well. And I found them to be like a really nice alternative to more hands-on investments for myself personally. How do you feel about that? Because I'm starting to get this point of view that syndications, given the volatility of house flipping and things like that I think are more bigger lifts, like syndications may end up being a kind of good option for someone in the beginning to get their feet a little bit wet without putting out a big risk there. How has it been for you? And then what do you think about that?
I really like the idea of syndications. I did it almost exclusively for 2 or 3 years because if you don't know me, I moved to Europe in the beginning of 2020 or the end of 2019 for my wife's job. And I had been self-managing properties for the 10 years prior to that. And I was like, what am I going to do? And I could buy more. I could have bought more, but it was in Denver. And Denver had gotten so expensive at that point. I was kind of ready to figure out sort of a next step. And syndications, it was a good time to invest in syndications in early in the sort of pandemic years. And I've done it. I think all of them are still, knock on wood, okay. One of them has suspended distributions, but right now there's no immediate murmurs about a capital call. So hopefully we won't get that. But honestly, I think I'm in 6 or 7 right now. So I think even if that one doesn't work out, that's a decent hit rate. Because I think if you invest in syndications, you need to expect that 1 out of 5, probably.
Yeah,
hopefully you don't lose everything, but might not be a winner. But I like syndications as a balance for portfolio because for me and I think you've been doing this far longer than I have, but I sort of have 3 buckets that I'm investing in right now. The first is I still own some rental properties in Colorado. I'm starting to buy in the Midwest. And for me, That's like my equivalent of bonds. Like a normal financial planner would say, you need to have 80-20 stock market bonds, depending on your age, maybe 30-70 at my age.
Yeah.
So those are my bonds, right? Those are safe. I have very little fear that they're, prices are going to go down. I buy assets that are solid, like we were talking about, but they're not that exciting. Then I need my growth opportunity.
That is a bond.
And that's, exactly. So that's basically my bond. And then my growth stock, the fun stuff, is syndications, because I am not handy. I have really no desire at this point in my life to learn to be handy.
Yeah,
I'm not going to flip houses, but it's such a good way to make money, is like value add investing. So I choose to do passive syndications to expose myself to strategies in real estate that I am not good at. And so that's, multifamily, value add, renovations, that kind of stuff. I think it's great, and it provides a good hedge. A lot of times commercial and residential markets work on different cycles, as we're seeing right now. And so that kind of helps you hedge and diversify. And then the last one I've just started getting into is notes and lending, which is similar to a bond, I guess, but it's just better. I like it.
Yeah. I've been thinking about the third, but in the middle, the syndications for me, again, I think, to be a good investor in any context, is to be diversified. Maybe most of us are real estate heavy, but you can be completely diversified inside real estate by separating the asset classes or the types of things that you want. And I found the same, like, I don't really like being a landlord at all. And I'm interested in multifamily, but I don't want to buy like a 13 unit and have someone manage it, because I'll just be annoyed. So I can invest in multifamily syndications and kind of like watch from the sidelines and have no control, which I'm completely fine with as a control freak. I'm kind of enjoying it.
Totally. I was trying to come up with an analogy for this the other day. I don't know if you're a sports fan, but I think of it sort of as being like a GM. Like you're kind of like picking the players, but you're not coaching them. You're not like on the field with them every day. You're kind of just like doing your research, sitting in your office, making a couple bets and seeing how it plays out. And like you do need to be diligent and, do your research and work with reputable operators. But I think as you progress in your investing career, this type of investing becomes more and more appealing, because you can use what you've learned, but you don't have to put the amount you can scale is not proportionate to the amount of time that you have to put in, which is great.
Yeah. I think this might lead us nicely to your last book, Start with Strategy, because it's really a way for someone to figure out how to get started and to make a plan. And that's one of the things that I think people are getting stuck in analysis paralysis. There's so many things out there, they can listen to so many podcasts, read so many books, but it's a lot of information to take in and get started. So tell us a little bit about that and how you would, how it helps people get started the right way.
Yeah, you said it well. Real estate, the beauty of it is that it's entirely customizable. Whatever your situation, whatever you want to make out of your portfolio, you can do it with real estate investing, which is so cool. But it is also very intimidating, especially, I don't know, when I started, there was no short-term rentals. I didn't even know what a debt fund was. I never even considered commercial real estate. I was just like, saw a house. I was like, I could rent that for more than my mortgage payment. And I bought it. It was like that kind of dumb decision. But now I think it's great, but there's so much information about every different strategy and all these different tactics that you can use. It's super overwhelming. And I wish that there was a one-size-fits-all answer to how you can start, but there isn't. And so I felt motivated to create a framework that would help people think through at least some of the biggest decisions that you have to make. And many of those decisions are the ones that we've been talking about today. Like, do you want to be passive? Do you want to be active? Do you want to diversify into multiple asset classes, or do you want to get really good at one thing? And I think by sitting down with the book and going through the framework, there's a lot of exercises in the book. It really can help you sort of figure out at least what your first and next few steps are. And that allows you to focus and not get distracted by all the shiny objects that are everywhere in our industry. And
so many.
Hopefully help you move forward, in a more structured, sort of deliberate way than chasing whatever exciting thing comes your way.
Yeah. And I mean, I think that goes to kind of a mindful approach again, which is why I started this podcast, because I feel like people really have to do a little bit of self-analysis, because you don't really know, but most people don't like being a landlord. So to think you're just going to get
That's true.
14 units in the first couple of years, you might hate it. There's so
Yeah.
many, I mean, we all know from buying properties over the years, like tired landlords, you know them when you see them, and you know them like, oh, it's the worst, and it's like, but you signed up for this. So it is important to go through that analysis in the beginning and say like, hey, that's a little bit more passive. And then really understand that almost nothing is truly passive other than syndications, but it's all part of the journey to get started. Don't you think people would be better suited if they took a little bit more time to prep themselves and really say like, hey, which of these things, which do I even like? Do I like something more than the other?
100%. Otherwise, you're going to burn out. People always ask me, hey, do you want to flip, or should I flip or buy a short-term rental? Like, those are two totally different businesses. And calling
both hard for first timers.
Yeah. And calling them, I think the term real estate investing is a little bit of a misnomer. This is entrepreneurship. You are starting a business. So you need to decide what kind of business you want to run. Do you want to run a super active business? Go flip houses. You'll probably make a ton of money if you get good at it. That's never been for me. I have professional interests outside of real estate, and I like what I do at BiggerPockets. I've never been someone who's like counting down the days to retire. And so I've, built a portfolio that sort of complements my career. And that's worked great for me. I know a lot of people whose whole goal is like 5 years, I got to get out of my job. And that's also great. But the approach and the type of properties you're going to buy, the markets you choose, the strategies you use, the financing you select is going to really depend on which of those plans or whatever other plan you want you select, because it's totally different business.
Hey, it's Jonathan. I hope you're enjoying episode 200 with my friend Dave Meyer. He's an absolute wealth of real estate data and information, possibly a robot, I don't know. But as we take a little break in between the beginning and the end of the episode, I want to say thank you to BiggerPockets. I had been investing for more than 20 years before I even found BiggerPockets 10 years ago, and it absolutely changed the trajectory of my investing career. I have hundreds of friends, thousands of contacts, hundreds of clients that I've met through BiggerPockets, and I couldn't appreciate the site more as it keeps getting better and better each year. So you can always find me on BiggerPockets in the forums. I'm actually a moderator now in the forums, so when you do some funny stuff, you might see me there. But I really appreciate how much the forums have to offer and how much investors are willing to give to people who just want to learn. So go in the forums, and soon, in this interlude, I will have a BiggerPockets Pro code for you. Don't have it yet, but stay tuned. Let's get back to Dave. Yeah, I've also been thinking a lot. I think people are scared to sell properties when they if you don't like it. This is one thing I really want your take on this, because this is something like I'm really, really sure about. And you really touched on it before when we were talking about syndications. You're like, hey, 1 in 5. I've been saying that every person who gets to 4 properties, they're usually in the forums on BiggerPockets saying like, well, hey, how do I scale? And I'm always going the other way and say, if you have 4 properties, 1 probably sucks. So the first thing you should do is, or 5, one of those is probably like not performing, but kind of the lure of having it as a door is there for people in that kind of FOMO sense. So they don't want to get rid of it. But if you repurpose that asset into something else, it might springboard you into something, even if maybe you take a small loss. What do you think about that?
I think that the buy and hold till you die mentality in real estate is just such bad advice. It's unbelievably bad. I get the sentiment that it's like, hold on and keep your money invested in real estate. I agree with that. But you don't need to keep your money in the same asset, especially because in the United States, there's something called the 1031 exchange, and you can you can reallocate your capital between assets tax-free. So why wouldn't you be constantly optimizing your portfolio? And honestly, I just think it's either a little lazy or it's vanity, because you want a certain amount of doors. And I know that's a very critical look at it, but I think as you scale as an investor, you realize like you have to constantly be optimizing your portfolio. I actually remember my first deal I bought in Denver in 2010, and I held on to it for 8 years. And I was like, I was not a sophisticated investor when I started. And it built so much equity, some of because I bought a good property. A lot of it's because I was in a great market. Some of it was due to macroeconomic, like all these things sort of went well for me, to the point where the property literally tripled in price. And for several years, I was like, this is amazing. I have this thing to fall back on. And it was very emotional for me, where it felt like my backup plan. This was like, I always have this equity in this property. It's worth more than my savings account and my stock portfolio. It's like, that was sort of my nest egg.
Yeah.
And then I started working at BiggerPockets in 2016. I was like, oh man, I've really messed up. I could have bought 5 properties with all that equity by now. And it was sort of just like a light bulb went off, realizing that you can't just buy and hold on forever. Like, oftentimes in real estate, you become a victim of your own success. Like great properties become inefficient because they've grown in value so much. And so you always need to be thinking about how to reallocate capital.
Yeah, it's kind of like you can really miss the wave. Like, to me, I've always looked at real estate just because of how I grew up with my dad. It's like, if the market's hot, I want to sell. I'll sell anything. I don't care. If I live in it, I will sell it and get another one if someone wants to pay me. And you know how some people are like, oh, there's no price that you could pay me for my home. Like, there's always a price that you can pay me for any property that I own. Like, I will sell anything. It's not a problem. But you made a good point, because it does feel like security for a lot, especially in a time now where, home ownership is becoming less and less affordable, and people are going to have to rethink what they're going to do. But that security can be repositioned into more security.
Yep.
Like, I always think of it, if you can hold on long enough where that property, then you can turn it into 2 properties. Like, that's what you should be thinking. Why hold on to it when you can turn it into 2 that are in better condition?
Absolutely. And I know this is going to frustrate people in the real estate industry, but I would get out of real estate if all of a sudden there was a better way to use my money. I don't think that's coming, and it hasn't happened to me. But if all of a sudden there was some other asset class that was created the same kind of benefits that real estate did, I would consider that. I'm not in this industry because I have some love of physical structures. I think that it's a great asset to invest in, and I think it's fun. So I like that. But I think holding on to it and sort of treating properties as precious is only going to come and backfire against you. And the great thing is that there's easy ways to evaluate this. Like, return on equity is a great metric. Go check your return on equity for properties you've owned for a while. It's probably going down because it should. Usually, if you've built equity, your ROE is going to decline, and maybe you should optimize and look into reallocating that. Now, the other thing is, maybe that calculation tells you that you should hold on to it. That's fine too. But do the math at least and figure out if you're holding on to it for a good reason or if it's just some emotional decision.
Yeah. And also, like we said before, actually assess the asset. If it's run down, it's like, I always see a lot of people who are like, I have 20,000 repairs to make, but I want to get X. And it's like, well, no, you have to just sell it for less, because you don't have the money to do the repairs. But it's doing the repairs, or there's no option there, unless you use one of these companies that's going to put it on novation. It's interesting. I wanted to get your take on this because I think this is something that's going to come up a lot. Like, my kids are now 21 and 23, and they're going to be looking at a different housing option, and I think that people need to start thinking differently about home ownership. I've made a career out of home ownership. I love it, but I also think that home is what you make it. I've lived in rentals, and it felt the same as owning a home. I just wasn't earning equity. Do you think that people need to kind of change their view on how they're using their money? Because I can see people renting smartly in an area that they like, and then buying investment properties instead of buying their first, quote, home.
Mm-hmm. The short answer, yeah. I've been thinking quite a lot about this recently. I was actually writing some notes for a future blog about this. But the unfortunate reality is that homeownership and affordability, it doesn't look like it's getting any better. I have a hard time seeing where that affordability comes from in the near future, unless there's some black swan event and mortgage rates go down to 2 or 3%, which could happen. But I don't know how to forecast that. So the things that I can forecast are it's not looking great. And I think that's okay. It's a hard thing to wrap your head around because culturally in the United States, we just believe in home ownership and that it's the best way to build wealth. And it can be, but right now, if you do the math, renting and buying a rental property is a much better investment. If you're just looking at it in pure dollars and cents, not security or the emotional element, which is important. But if you're looking at a pure dollars and cents perspective, it makes a lot of sense to rent. And I'll just tell you, when I moved to Europe 5 years ago, I did the calculation and I decided to rent and to keep investing in the United States. Now, the market's gone up like crazy here, but I don't regret it. It was the right mathematical decision. And I think a lot of people are going to have to work on that. And I do think, renting smart, as you mentioned, is one of the big things here, because this is a whole other philosophical conversation. But I think part of the reason people have a hard time with imagining remaining as a renter is because there's this, in the US, sort of this perceived adversarial relationship between tenants and landlords which I don't agree with, or I don't think it has to be that way. And there are definitely bad landlords and there are bad tenants. But I think the majority of people out there are reasonable human beings. And I do think it's sort of on us in this industry to try and figure out ways where we can make renting viable to people long term, and they can feel the sense of security and pride and sense of home that you do in a rental property, because that's just the math says that the average American can't afford the average price home anymore. And so it's going to have to change one way or another.
Yeah. But think of the people who, you're in a big city, New York City, you're in LA, you obviously are not affording a home, in your 20s, but you're making good income, you're making 100 to 200 grand. You can buy a property in the Midwest and you can start your journey as an investor before a homeowner. Whereas I think, if people think like traditionally, they think like, okay, well, I have to do it in these steps. And I think we're going to see a lot of difference, similar to what we were saying about, hey, maybe syndication's a first investment now instead of a flip. Yeah, I think it's going to be interesting to see. And this is what I'm talking about with my kids. Like, hey, there's other options out there for you. We have to look at it differently. Everyone, and I smartly rented myself. Like you said, you're doing in the Netherlands. Like when I sold one house, my kids were, one had just graduated high school and the other was 2 years out. So I didn't really know where we were all going to end up. I didn't know if they were going to go away or not. So when I sold my house, I did great because I sold at the top of the market because I don't care. I'll sell anything. Yep. And then I moved into a rental for 2 years, which was perfect for us at the time. And I didn't feel like I was throwing money away. I was like, that's a smart decision. And then I bought again, and now I'm doing well on that house. And I could see myself renting again at some point, even though as someone who's owned, 100 homes, I look at it and I'm like, I could rent in a city for a year. Like, that sounds like fun.
Yeah, totally. I totally agree with you. Going back to that first deal I bought that intending to house hack. Yeah. And I wound up, a friend of mine in the city, his grandma passed away and he was going to move into his grandma's house. He's like, do you want to live in the basement? For dirt cheap. It was like in the suburbs. It was actually in a retirement home. It was pretty retirement community. It was pretty funny. I lived there for 3 years. But I was like, I was young. I was trying to figure it out. I was 23. I was like, I'll go live for cheap. And then because I could rent out the apartment I was going to live in, and it was I think it saved me like $700 a month. Yeah. Which at that time in my life, that was more than my discretionary income per month. That was like tripling my discretionary income that month, or, at that time. So yeah, I think it's just about trade-offs, but there are going to be ways to gain efficiencies, like what we're talking about. It's just if you're willing to sort of accept some of those trade-offs from the traditional quote unquote American dream.
Yeah. Yeah, we'll just take a quick pop into house hacking because it's, of course, what the funniest thing, though, is now, like, of course, your episode 200, so many people that I've interviewed were house hacking before it was a term. Like, it was just smart investing. Like you said, you look at a property, as an investor, you buy it and, I get more rent than my mortgage. Like, we're not reinventing things. It does have a new term. But don't you think now house hackers need to look at it again, like with a little bit of a different lens? Like you're probably going to be net negative while you're there, and you really need to judge it when you get out. And I think that's kind of changing it, because where I am in New Jersey, like multifamily sell for more than anybody can imagine. Like it's insanity. So they say, the numbers aren't working. And I'm like, again, it's asset versus what your long-term plan is, right?
Yeah. I think the word on house hacking is out, and listing agents have learned that they can price it differently and price it more aggressively for these duplexes. You even see it in listings. I don't know if you see it, but when I'm looking at small multifamily, you see perfect house hack, owner occupied investment. People know.
Yeah.
And the fact is that if you are a house hacker, the underwriting is different, and you can pay more and still have it be a better financial decision for someone who's not going to own or occupy. Yeah. And that is going to push up prices, and maybe it will go away. But given our conversation, I don't think it's going to go away, because it's still an attractive financial decision, but it's not going to earn you cash in the way that it used to. I'm trying to remember. So that house, I wound up not house hacking, but the next one I bought, I did house hack. Yeah. And I'm trying to remember if I even broke even on it. I don't think I did even back then. And it was one of the best investments I ever made. I made an incredible location. And I live, it's this huge, beautiful house. And I lived in this like tiny little attic thing and took care of the property, and it was great. And I'll do it again in a second.
Yeah. I mean, if you just go through our conversation now for 43 minutes, we're just talking about so many different options for real estate investors. Like there's so many different ways that this can be interesting. And I've been saying like, I think a lot of people feel like, oh, if they spend, 6 months researching house hacking and then they decide it's not for them, they're like, oh, I ruined it. Like, my whole journey's messed up. You learned like so much. Yeah. Don't you think I do think it's helpful to hone in on one thing, but I don't think, learning about the other things is going to hurt you in the long run. It's only going to help you understand just real estate as a whole.
Yeah, I totally agree. I think real estate is not, I feel like over the course of almost everyone's real estate investing career, of the people who've been doing it for a long time, you touch all of these different strategies and ideas, and you're going to get exposure to them sooner or later. So you might as well do it now. Like learn about house hacking. You're not going to do it right now. Maybe you'll do it later. And I know a lot of people think, oh, I'm get older, I'm not going to house hack. Maybe you'll house hack a short-term rental. Maybe, who knows? I think that I learned about commercial real estate years before I started investing in commercial real estate. I thought about it, and then I was like, residential is going great for me. I'm just going to keep doing what I was doing. It was only until I was sort of forced into syndications by moving that I started to apply that knowledge. So I think that, you just treat it like an ongoing experience, like you're just continuously learning, and some things are going to be more useful to you now, and some will be more useful to you later. But if you stick around this a long time, there's no amount of learning, I think, that is going to be wasted.
Yeah. You said something important before about not wanting to retire. And I think this is important for investors to understand, because a lot of the people who say, well, if I get to X amount, then I'm going to retire. So they rush themselves to get to those 20 doors that equal X income. But then they, quote, retire from their 9 to 5, and they have way more than a 9 to 5, in their management, or they're paying out way more in property management. Whereas I think of it like you, I have no intention on retiring. I've been on time freedom already for 15, 20 years. So I like real estate. I'm not going to stop playing with real estate. I enjoy it. But I think there's a problem for people who are hustling to get to that number, because then they stop, and I think they're going to end up with probably a much bigger job. What do you think about that?
Yeah, no, I totally agree. It sort of goes back to our conversation about what you actually want.
Yeah.
And for a lot of people, I think, for better or worse, social media people talk about quitting your job and romanticizing this idea of quitting your job. And let's just be honest. First of all, it's not that realistic in the short run. Yeah. Two, if you're going to do it, you're going to, in a short time frame, you're going to have to take on a lot of risk. The types of deals that you're going to have to do to make that work in, let's say, 5 years, unless you're starting with millions of dollars, is just not realistic. And then I think third, I don't know about you, but I know a lot of people who retire and then just go back to work because they get bored.
Yeah.
Like, I think it's just this idea that people get in their head, and they haven't really thought about what they want to do. Like, I don't know what I would do if I didn't work. Like,
No, retirement sounds terrible.
Yeah.
But that's why I think it's not really, they're not chasing financial freedom or retirement. It's always time freedom. It's just the ability to do what you want when you want. I mean, if you want to call that retirement, I've been retired for a long time, but I've been working a lot of jobs.
Right. Yes, exactly. Yeah. I think it's similar. Like, could I not work? Probably. But I don't even know. I haven't really even thought about it. You know,
like how many times can you go to the gym a day? I mean, what's there to do? I take walks anyway.
Yeah, exactly. And like, I live a pretty flexible life. And that's what I've always wanted, is just being able to, I work on the weekends sometimes, I go on vacation sometimes, like I have the work-life balance that I want, and I'm going to just keep doing it.
Yeah, and I think it's very hard for a guru or someone to tell someone what their number is, because what your number is to be, time freedom, and what my number is, and what somebody who grew up in the Midwest and always, was in an area where the house prices just weren't that high, our numbers are all going to be different. So you don't have to achieve as much as some might think in some areas. And like we were saying before, in where people may migrate to, I also agree that I think a lot of people may end up with mobile jobs migrating to more affordable cities in the Midwest, because, who can afford LA or New York City? Exactly. It's crazy.
Yeah. I mean, it's something I've thought about, you could too. Move up your retirement date by, I don't know, 5 years, a decade. Yeah. And you just move somewhere. Like, honestly,
I know.
And I'm going to be honest. I don't envision myself living somewhere super cheap, but the difference between living in an expensive Midwest city and an expensive Northeast city is a lot.
Yeah. But I also,
Yeah. So I think that you can customize this and come up with it the way that you want. And that's why thinking about like, what quality of life do you actually care about and want? Because you can build that portfolio, but you need to think about it first before you go out and start buying stuff.
Yeah. Yeah, I think of it a lot for myself, like in the Midwest, like I could buy so many more houses. I could have so many more rentals. I mean, I can do it now, but if I was living there, I could be like, back to my old school ways. Like, I could be driving these areas and finding stuff. There's just so much more availability. Totally. Whereas here in New Jersey, it's just, the prices are just insanity,
and your taxes are crazy, right?
Yeah. There's really, you do get the warm, glow of appreciation, which has been really unstoppable for most.
That is nice.
We need something to help it. Well, Dave, as we wrap this up, you are obviously studying data and trends all the time. It's what you're obsessed with. We already established it's what you're dreaming about, tables, pie charts. What are some data points that you're looking at, or that are going to make a big difference in how we invest over the next year?
In the next year, it's boring, but I do think mortgage rates are going to be sort of the key to the market because affordability. I think we see that people want to buy homes; they're just priced out, and I don't see the market crashing. Wages are going up, but it would take a long time for wages to go up to make affordability make a dent. And so if there's any hope that the market gets unstuck and there's some affordability, it's going to come from mortgage rates. And that's a whole thing in its own right. That's kind of why we talk about it a lot on the market. But I think that's the major thing. The other thing we haven't talked much about that I personally think a lot about is like, is it going to be a good time to buy commercial real estate soon? Mm-hmm. I think we've been in this decline. I would even call it a crash in a lot of subsectors of commercial. Yeah. And I wonder if we've seen or approaching a bottom. I'm not saying we have, but that's sort of something I'm toying with, is like, is it going to turn to a buying opportunity from what's been a big wait and see opportunity for at least 2 years in commercial? Yeah. And so something I'm going to be looking at.
I think on the large scale, there's probably going to be a lot of opportunity. That mid-range, it's still like it's so tough for people to let go of it because they're just barely getting by. And then there's all the repurposed use of commercial spaces that's going to be important, but not as easy as people think to just turn, a Sears into, something that's housing because of the bathroom situation. Hotels are really cool because they're easy to turn into multifamily because they all have bathrooms and kitchens. So you're not moving, gas and plumbing. But reconfiguring, a 20-story office building, which has one bathroom per floor, into residential costs too much money right now.
Super expensive. Yeah. Something tells me that it's going to take off in the years, but it's going to have to be some sort of public incentive for developers because it just doesn't pencil right now.
I agree. Yeah, I think multifamily, especially we were talking about syndication, is going to be interesting because we were talking about Texas before. Like you said, they brought on so many units to account, and now they've outpaced the demand. So now it's like, now we're looking at, hey, well, what's going to happen with rents in these areas? What does that mean for value? Of course, these are still great places. People are still going to be migrating to Texas because of the economies of the taxes. But totally. There's a surplus of multifamily in a lot of areas. But still, if we have an affordable housing crisis, it means it's eventually going to be full. So I'm still looking at multifamily. I think you were talking about this you talked about this at BPCon. Yeah.
And now, if some of my hunches don't take this, I'm just sharing with you some of my sort of things I've been thinking about the last day. So this is not a fully formed thought, but if my theory that rates are going to stay relatively high for a while, that should keep construction down. Like especially in multifamily, it's super expensive, it's risky, and so we're seeing a real dearth of construction right now. Just for everyone's education, like during the COVID boom, we saw a lot of people start multifamily, but as soon as rates started going up, all buildings stopped. I mean, not all, but pretty close. There's not a lot of building. And if rates stay high, like I don't know how attractive it is going to be to develop multifamily. And in an environment where we know that we're millions of units short, that will probably push up rent. One thing to think about, I don't know if this is true, but like better or worse, like a lot of construction is done by migrants. And so the other thing to think about is if there is deportation and the construction labor force declines, that's going to make construction even more expensive, which will exacerbate the housing crisis and push up property prices and rents. I don't know if those things are true. These are things I think we need to like wait and see what policies Trump pushes through. But they're just scenarios that I think are going to be really important to consider.
Yeah. I mean, like we started with, I think there's going to be a lot of things out there that are going to maybe adjust, but now's always a great time to just keep watching, keep learning, keep trying to figure out what asset class might work for you. And like we've repeated a few times, really figure out what you like. That's start with strategy in a nutshell. Like you really have to do a little bit of due diligence on yourself instead of looking about, well, everybody on TikTok likes multifamily, so I'll do multifamily. I don't really like people, so I'm not going to be a good landlord. So, it's time to look inward and then figure out what those assets look like.
It's so true. I guess this is just my personality. When people are like, everyone on TikTok's like, you should do this. I'm like, I'm going to do literally the exact opposite. I don't even care if it's good advice. I just don't want to do what everyone's doing.
Whichever way the salmon are going, I want to go the other way because it's just at least going to be more interesting and there's going to be less crowds. And I don't like crowds.
Yeah, exactly.
All right, my friend. Well, I really appreciate you swinging by for episode 200, a milestone for us here at Zen and the Art of Real Estate Investing. Really appreciate your time, as always.
Well, congratulations, man. It's a great show, and it was an honor to be here. Thank you.
Thanks. And you can find Dave in so many places, definitely on BiggerPockets. You can find him as the host of the BiggerPockets podcast and On The Market with his friends Henry Washington, Kathy Fettke, and James Daynard. And occasionally other guests pop through there on The Market as well. All right, Dave. Appreciate it, man. Talk to you soon. That was Dave Meyer. I'm Jonathan Green. We'll see you next episode. We start our next century of episodes. Next episode, my guest is Ken Gee. He's the founder and managing member of KRI Partners, a real estate private equity and investor education firm. Ken goes way back like me, and we talk old school as we've both been in it about 30 years. Stay tuned to the next episode. And again, thanks for taking us to 200. See you next episode.